Hey, what's up, financial advisors? It's me, Sarah G, with the Smack, and I am back. And today I've got Broc Buckles here of BC Brokerage. Hello, Broc.
Sarah, what's going on? It's good to be here with you.
The topic I think would be how insurance is changing for the fee only space, which Broc is certainly very knowledgeable about.
Yeah.
Woohoo.
Yeah, for sure. Again, thanks for having me on. And I would say, for the fee only space, there's just becoming more options available, right? Like more firms that are kind of starting to help serve them and create opportunities for products to be implemented in a more transparent and honest way and kind of keeping them in the loop the entire time. And that's been one of the things that I think has needed to happen in the industry for a very long time, because it kind of seemed like two different parts of the industry, right? You had your insurance and then you had your fee only or your RIAs or the investment world.
So let's say that I'm a fee only advisor. Let's just suppose a client comes to me and they've got a whole life policy. I'm not familiar with the carrier. I'm not maybe the best at the analysis of it. I'm kind of plodding along in my e-money portfolio updates, social security, retirement age type world. What you
Yeah,
think you
and
do in that situation?
do an analysis on the policy, right? And just kind of look at the nuts and bolts. Like, what is this thing? Why was we always start with why is this in existence, right? So what we always start with was this actually solving something or was it sold to someone? And it's fairly easy to tell, right? Because when you ask, do you know why your client has this? Or more importantly, does your client know why they have this? If they can answer it very specifically and they can say, I have this permanent policy because I have a child that has special needs and we really need to plan for, their continuation of lifestyle in the event something were to happen to us. We know that we probably have a justifiable policy and now it's just a matter of, is it the right policy, right? But we know that we probably are in the realm of permanent insurance and it's justifiable. If we ask them, why do you have this? And they say, well, it's my retirement plan. Then we know that it was probably sold to them and it isn't something that they necessarily need. And so with that, a lot of times the best option is just to get out of it. But if it is something that they need, again, kind of going into that policy and making sure that it was designed properly in the right way by analysis is what we try to do.
Brooke, what are the signs, though, of a good analysis? Because this whole thing, the insurance industry is propped up. I'm not saying that you're one of these people,
Sure.
but the insurance industry is propped up by the lack of transparency with the analyses that are used to justify sales of these products. That's what's holding it up.
Sure.
Because it's like you could get the consumer to probably agree to anything that their financial advisor is going to say. And the issue is, though, that I think the financial advisors are having the wool pulled over their eyes by bad analyses.
Yeah, no, I could appreciate you saying that. I mean, for sure, you need to make sure that you're working with the right insurance professional, right? I mean, I think that would be number one is work with somebody that you feel is actually doing good work in the space and that you feel like is going to look at it through the same or a similar lens, and understanding the way that you work with your clients. And I think that the way that you can dictate what that analysis is or the quality of those analysis is based on more than one analysis, right? So if it always seems to be the same answer, which is replace this, move it over, or give it to me so I can make a commission on it, then all of a sudden maybe you have a problem there, right? But if the advice is, maybe cancel the product, or maybe you could take the product paid up if they need it, but they don't want to continue paying into it. So, when you talk about analysis, it depends, number one, on the product line. It depends, number two, on who you're working with and kind of the reason for the analysis. So what we rely on a lot of times is the scope that the advisors give us and how this fits in the overall financial plan. Because we always come from the philosophy of planning before product. And that's how it's always been since the inception of our company. And so, yeah, I mean, obviously you have to work with a good insurance professional to be able to get a good analysis. But is that answering your question?
You said the planning before the policy, and I agree with you because I've heard examples of people who got sold an annuity that
Yeah.
they didn't necessarily need, that they thought they were going to need the income, but they didn't, because they got sold on this whole thing about like whatever the annuity salespeople say, like upside with no market downside or whatever it is. Okay. And then they got sold it And then it turns out that they actually didn't need the income and they were making more income than they ever thought that they would, which then pushed them into a higher IRMA bracket.
Sure.
So now they're paying higher Medicare premiums.
Yeah.
So it blew up the whole plan. And it's just because it's this whole thing of the product being sold or the decision being made without the long-term vision in mind. So I'm so glad that you said that. So that's the first takeaway from this podcast. Okay, everybody, fee only advisors or anybody listening to this, don't buy an insurance product for your clients from somebody who doesn't understand what the financial plan is that this product will be a part of. Would that be a good rule?
Yeah, absolutely. I mean, as a general rule of thumb, I don't think any product should ever be implemented without understanding what the full financial picture looks like. Yeah, I would say absolutely that would be a good rule.
Okay, so the financial planner or advisor should take the analysis that the insurance person does and then plug that projected income stream, tax implications of whatever the product does, and implement that into their financial plan and projections for the client on what basis? 10-year, 20-year, 30-year, all of the above. How far out
All
should
the
it go?
above depends on the plan, right? So all of the above. I mean, what we say is when advisors come to us and they say, okay, here's the deal, here's this product, look at it. What do you think? Here's the client situation. We're not just looking at the product and saying, okay, I mean, one of the things we're doing is saying objectively, is this product good or bad? Right? Is it in general, is it just a terrible product? Because if it's just a terrible product in general, that's a problem in all of itself,
What's
right?
an example of a terrible product?
Uh, just a product to where, somebody was sold on the cash value of a policy going up, and a company where, it historically has terrible dividends, and, products that are over illustrated and consistently underperform, right? So a lot of times people are showing in IUL policies massive returns that are completely unrealistic, especially for a policy or a product line that hasn't been around nearly as long as a lot of others. Right. So, this goes to that kind of TikTok people saying that you're going to earn 15, 16, 17, 18, 19, 20% every year off particular products. It's not, I mean, that it would be ridiculous to do that. Right. So first, I think you have to start with objectively, is the product a good product or is it a bad product? Okay. And then you have to say, okay, now we're talking to the advisor based on their financial plan, based on what they're trying to accomplish in retirement, based on how comfortable they are with market fluctuation, the way that all of that looks and how that feels to them. Should they have an annuity, right? Because you could always make the argument that had somebody just kept the money outside of an annuity and let it ride out in the market, it would have performed better, and they would have had more money in the long term. But telling somebody that, who every time they look at a market fluctuation in their portfolio, they want to get physically ill, right? And they want to have that guaranteed money because for whatever reason, right? There's the behavioral side of finance too. It just makes them feel better to know that there's going to be that money every month. There's that side of it too. Right. So you're kind of trying to balance these two sides. And that's where, when you're doing the analysis, it's not only, what are the numbers saying? It's like, these are the way that the numbers make my clients feel. And so we get really deep and intentional, above just looking at, is the product objectively good or bad?
What are the typical components that I need to take with me from your analysis and then plug into my financial plan?
Yeah. So, I mean, in general, you need to be looking at the internal rate of return of the product. You need to be looking at the cost of insurance in the product. You need to be looking at the company and the historical performance of the product. And you also need to be looking at the overall financial strength rating of the company, which is going to show the likelihood that the company is going to be around for a long time and in good standing. Because if you're talking about 10, 15, 20 years from now, that stuff starts to really matter. And if you look at the history of the insurance industry, you can see companies being swallowed up by other companies a lot. So those are the things that we definitely intentionally try to look at.
I'm the financial advisor sitting here. I get the inputs back and I'm overwhelmed. How do I know which analysis is good. Let's say that you're the good guy, right? Let's say there's like, there's one like kind of okay guy, and then there's like a bad guy, right? Like, how do I
Sure.
know the good guys from the bad guys when it comes to getting the analysis back? How do I judge
So
that? I would be a fish out of water. Like, if I'm a financial advisor, let's say I've never been an agent, I don't know these products well. Like, I'm at your mercy and the mercy of the bad guys, which is what I'm saying about the wool being pulled over the eyes.
yeah. So that's a good question, Sarah. What I would tell you is, number one, if something feels funny, it probably is, right? So I've worked with a lot of people that have been very focused on commission, are very focused on trying to take people's money, and are very focused on trying to sell products. So if the entire analysis has to do with replacing the product for an for a reason that you can't really put your finger on, right? Like you can always, if it seems too good to be true, it probably is. And so I would say, number one, if you're getting three analysis, that's going to be a lot anyway. But when you're getting the analysis from somebody, I think that you should try to understand their background, where they're coming from, and it should be very clear as to why they're recommending what they're recommending. So we try to make the analysis when we do that for financial planners so blatantly obvious and so clear that it makes complete sense. And beyond that, we're not just telling them, hey, here's one option, right? So if the analysis just includes, here's what you should do, you should change this product to something that I'm going to manage, or something that I'm going to sell the client, or something that I'm going to make commission on, run, right? Go run as fast as you possibly can. What the analysis should consist of is not only objectively how the product performs, what the product is, and what the product does, but also, if you do option A, here's what happens. If you do option B, here's what happens. If you do option C, here's what happens, right? And then what we'll say is, this is what we would likely recommend doing. But again, I think that you also need to know who you're working with, and you also need to look at the history of the people that you've worked with and what their recommendations have been throughout that relationship, right? And find somebody that you trust and really lean on them heavily. So I would say it's if you go to get three different analysis, you're creating a lot of work for yourself. If you want to do your due diligence, I think that's fantastic. But what I would say is try to find somebody and understand from the get-go what their philosophies are, why they say the things they do, and why they think the way that they do about insurance, and make sure that you kind of align with them on most of that stuff. And if you don't necessarily know a ton about the insurance, so you've never spent any time in the insurance world, and the extent of your knowledge is what you learn in the CFP curriculum, then try to kind of educate yourself with, talking to other people, other family planners, and understanding kind of the trains of thoughts that they have around the stuff.
Insurance crediting rates can vary in accordance with interest rates.
Sure.
So how do I know that if an insurance crediting rate is projected out to be 12%, that that's unreasonable? How do I know if that's unreasonable or not?
I think it can be pretty obvious, if things are over illustrated, right?
Okay, thank you. What are the signs of something being over illustrated? That's a great term for it.
Yeah. So, I mean, if you're looking at things that are consistently showing 15, 16, 17% returns in a policy year over year over year over year, that's being over illustrated, right? That's ridiculous. If you're seeing things that are, kind of right along with, they're more conservative. You're talking, lower rates than that. I like illustrations to be very conservative, right? I like things to be very conservative, and let's put our chips on that, that it's going to be that. And then if it's above that, then let's stay away from that product line. And honestly, if something's being promised to someone at a super high rate, the teens every year, the 20s every year, which is insane, but unfortunately, some people are doing that. they're making their own Excel spreadsheets to do that, then it gets very, very fishy. I'm saying that a lot of times what you'll see out there on social media is people that will use Excel spreadsheets, plug their own formulas in, and then try to convince people as to why they should buy a product line based on literal. They're not even using the actual policy documents. They're putting it into an Excel spreadsheet and they're using their own formulas to try to explain and sell to people certain product lines, is what I'm saying. Like you'll see that a lot of times on TikTok. You'll see that a lot of times on LinkedIn. You'll see that a lot of times on Twitter.
If you could tell the financial advisors listening to this one thing that, or just tell financial advisors how to do insurance right for their clients, what are 3 things you would suggest they do? And what are 3 things that you would suggest that they stay away from doing?
Well, the number one thing would I would say, make sure that you make sure that philosophically you align, right, with the person that you're working with. Um, the other thing I would say is make sure that you feel like the person that you're working with is doing their due diligence, looking at multiple carriers, understanding kind of the ins and outs of certain product lines, understanding the ins and outs of clients' health, because that's one of the biggest things. I mean, bottom line, when it comes to insurance products, obviously it's not as big of a thing with annuities, but you really do need to understand how to navigate the insurance space when it comes to people's health, because very literally the products can differ by the thousands of years. So you can really put somebody into something that they're going to pay substantially more for if you don't know how to navigate those companies and which companies are better with certain health considerations. Um, and I mean, the overall thing is work with somebody that you know and feel like you can trust. I mean, that's the biggest thing is, people work with people that they like, know, and trust overall. And so, really get to know the person, see if you jive with that person, see if you get along with that company, and if you feel like they do good work. I mean, and the only way to do that is to kind of have, an introduction meeting, ask intentional questions, and try to understand if you're going to work with them well. And then in terms of what not to do, was that the question, or what to look out for? I would say, try to look out for people that are pushing certain products, trying to sell things consistently. It always seems like there's a one size fits all answer out there. So just make sure that you're working with someone who you feel like is doing the right thing in accordance to, what your values are, and as an advisor, and you feel like are going to take care of your clients in the same way that you would.
When somebody says, when an agent says, I'm going to shop around with a lot of different carriers, how do you know that they actually looked at carriers that would be good for your client versus just going to the typical places that they go?
Well, I mean, a lot of times when advisors ask us why, I would just say ask the question, ask why they chose the carrier. I think would be the most obvious, I guess, response to that. A lot of times when advisors ask us, or there's a health consideration, they'll say, well, why would we go with this carrier over another one? And I think that if they're able to give you a good answer, we went with this insurance carrier because, this carrier deals very well with type 2 diabetes. And based on all of the other carriers, here's what the pricing was going to look like. And kind of give them a pricing matrix. It's not uncommon for us to give advisors 4 or 5 other prices from different companies and kind of just show them what it would look like from those different carriers. But again, I mean, how do you know? I mean, that's a matter of, working with people that I think that you can trust. Again, I guess that in order to know, you just have to ask the follow-up questions. But a lot of times when advisors do that, what we do is we say, here's, 3 reasons why we went with this company, and here's what the pricing was going to look like if we went with another company.
Another question I have about insurance is, when I got my term insurance, I was like, what if this company goes out of business? And the agent said, well, that's not to worry, because normally when that happens, the agency just gets bought up by another insurance company. But Brock, is it just a simple change of accounting entry, or is are there changes that happen to those policies when the company gets bought by another company because it goes out of business?
Yeah, I mean, it depends, right? It depends. I mean, certainly when companies get gobbled up, and I think a good example of it would be the long-term care market when that kind of came out very early on. A lot of the companies that were in that space kind of got bought up, or these companies get bought by other companies, and then we're looking at a rate increase or a traditional long-term care policy that's now going up by 30 or 40 or 50%. So it definitely does happen, Sarah. I mean, you definitely can't guarantee that it's going to be the same, and definitely can't. Things definitely can change, and that's why you saw so many companies go out of business in kind of the late '90s, early 2000s, is because they were trying to create these new products. They were making the benefits way too high. They were making the benefit lengths way too long, and they were making the premiums way too affordable. And so it just wasn't a sustainable product in terms of the insurance company could fulfill its obligation to keep that policy going. So a lot of them unfortunately got out of it, and then other companies kind of bought them up. So that's one of the I think one of the saddest things that we see now is people having to decide what they're going to do. Right? Do we move to another long-term care? Long-term care is important to us, but we just got a letter in the mail saying that our premium is going to go up by 30% this year, but we need the long-term care because we were planning for this. What do we do here? Right. And that's where you kind of do get into the numbers and you say, okay, well, unfortunately, the answer a lot of times is still keep the policy because the benefits are still more competitive. And if you were to try to get another policy now, it would likely be unaffordable. So yeah, it definitely can happen. Policies can change, premiums can go up.
Well, Brock, thank you so much. This has been very informative. How can people reach you?
Yeah, I always tell people, feel free to reach out to me. It's Brock at bc-brokerage.com. I'm on LinkedIn, post a lot on there. And yeah, feel free to reach out anytime. I always love talking to anybody and answer any questions anybody has.
Amen. That's great. Thanks, everybody. See you in the next one.